Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting. So the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been
talking
about.
It's an expensive place to find out. Crypto Vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life. Hi guys, welcome to The Big Picture. My name is Joe Cruy. I'm at Paradigm in the weeds around everything crypto vol markets. Joined here today again by Sohan and David, my colleagues. And today we also have Kyle Song on from Albatross Labs. Before we begin, if you like this content so far, hit the like and subscribe button. Really helps us as we continue to grow this channel. Appreciate all the support that we've gotten so far. To jump right into it, Kyle, you're new to the channel. Want to give us a little bit of a background on yourself for our viewers? Tell us a little bit about what you're doing at Albatross, what you were doing beforehand, and why you got into crypto vol.
Yeah, thanks for having me here, guys. My name is Kyle. I currently at Albatross Labs. I come from more TradFi background in options market making and vol relative value trades, as well as HFT trades in option space. I worked at Acuna and Power Research mostly in TradFi space. Dealt mostly on the commodity FX side. So I traded a wide range of products there. And most relative stuff to crypto, I ran the gold and FX desk at Acuna. And early on, I saw a lot of like similarities in crypto and gold market actually. So it kind of like made a lot of sense. We're kind of seeing the institutionalization in crypto and see a lot of like similarities, what I saw from like gold market and like what's building up in FX. And for Albatross Labs, we started about a year and a half ago. We actually started more on the latency stat arb with trades and using like perpetual futures and variety of exchanges. So we were doing more of a high frequency stuff early on, and then kind of built kind of expanded out to options as it is like my main interest, I would say. And we currently are building up our options desk, trying to increase like presence in Paradigm as well as all the other options venues.
Yeah, no, that's cool, and we really appreciate all you've been doing for Paradigm, and we've seen that firsthand. You see, you guys kind of right when you kind of started to really ramping up to top 10 market maker on us. So kudos to you, and looking forward to keeping that going. I'd like to go back.
Carl, I've just got to jump in before Joe carries on.
Yeah, go.
Is it just interesting you saying you traded sort of gold options and stuff before? So I've got to ask you, is Bitcoin digital gold?
I actually initially like that was like kind of obvious to me like early on, like for me at least. I always thought it was going to be like alternative to gold. Made like a lot of all the narrative made sense, and that was like when Bitcoin was like around like 3,000 maybe back in like 2017.
Yeah. The thing that's funny about it though is like, especially in the vol world, and this has been a common theme we've discussed on this podcast, it really feels like the regimes, can change quite a bit. Like when I came into this market, I was like, oh, damn, like it kind of feels like Bitcoin and Ethereum, especially Ethereum, just kind of trades like a single stock, like NASDAQ. This NASDAQ stock, everything was so correlated, ETH, NASDAQ, Corel, realized Corel was like 80, right? And everything kind of moved together. The vols kind of seemed to move in similar fashions too. And then you kind of fast forward to like the beginning of this year, and it's just like, wow, now it does not feel like that. So like, what are the things for you where gold and the gold options market feels a lot like BTC in the ETH option market?
I think ETH might be a little different for Bitcoin. Yeah, I guess like fundamentally, I guess it is like alternative assets to hedging against like other assets type of narrative, as well as like just like more on also on like more on a micro level side of things, like how things move and like like skew and convexity dynamics, vol dynamics. Like it feels like very similar to at least like I haven't looked at gold options for a few years now, but like I'm referring to like back in like early 2010s. It seemed feels yeah.
Yeah, I'm guessing there's like a positive spot vol correlation with gold, right? Because given that's a risk-off type asset.
Course, yeah.
So which now we obviously strangely have like with Bitcoin and ETH. So I mean, I guess that's quite.
We did. I mean, like, well, so we'll see. I mean, now that the macro is deteriorating, that we're at 22,000. Like, I don't know. Like, I'm not gonna throw in the towel yet, but like, it kind of feels like that. Spot up, vol up sort of euphoria seems a little bit less likely now. But hopefully, I'm wrong there.
Yeah, well, crypto. There's such convexity in the moves, I guess, both ways. So yeah, like
the moment we break out of a range, the spot, I mean the skew will completely flip, right? I mean that's the thing. It's wherever there's danger, right? So I mean it makes sense that the danger is still to the top side. But I mean, really speaking, I mean, everyone's still worried about the bags on the downside, right? Like, if spot hits like 15K or something, I mean, we're gonna have another long winter.
Yeah. Well, I like at Paradigm, I'm selfishly more worried about the range bound where we just shop between 22 and 25 because nobody's going to trade, right? Like everybody's going to lose interest. At least we go lower. People need to trade, right? Anyhow, that was kind of a selfish comment, but I guess let's jump into the ETH BTC Vol Spread. Here, let me just share my screen quickly. Can you guys see that? Okay.
Yeah.
All right. Cool. Yeah. So the ETH BTC Vol Spread, it's been kind of an interesting one. It's been a one-way train lower. And now is kind of at five vols over for at the monies. I mean, is it quote unquote cheap? I mean, no-ish. I mean, it's kind of right in line with the trailing realized spreads that we've had. But that being said, it has continued to trend lower. And on an absolute level, it's the lowest since May of 2022. And then the chart on the right, what that is doing is that's normalizing the spread for the absolute level of implied vols. Like, i.e., you would expect spreads to be tighter if you're in a lower vol regime, and you'd expect that vol spread to be wider in a higher vol regime. So that's something that we normalize. And even when you do that, it is still quite low, right? It's trading at, the lows over the past year. And there was this research piece that came out, I think it was by Matrix Port yesterday, and that was saying that when the ETH BTC realized spread kind of compresses to the levels that we're around right now, this is the time to really like jump in and buy the spread, it's certainly a fair argument looking historically, especially ahead of things like the Shanghai upgrade. And, if you make this argument that Ethereum is going to be more correlated to risk and risk is rolling over, then there is arguments to be made there that the spread will perform. But I have some thoughts on what's leading to this spread compression, but Kyle, I would like to kind of hear what you think around this.
I think it's a mixture of variety of things, but I would say like I'm not like we're not like making we're not trying to make a hero call on like where the future will be, but like trying to like more of trying to explain like where it built this way. Obviously like realized vol's been super suppressed, whatever the reason is, and yeah, as you said, ETH realized has been like much lower than it's at like historical lows basically. So it kind of makes sense to like kind of converge, like imply the vols converging to realized. And yeah, I think like it's pretty interesting, but like yeah, we're not really like trying to predict the future, but like trying to make sense of the situations. And yeah, I think it all makes sense like vol like as like nature of crypto, Bitcoin, ETH, we usually see like, yeah, very like no move or large move type of like very like very like polarized distribution of movements. So that kind of creates dynamics on throttle sellers try to like basically like realize has like imply has to like converge to realize. That's been a lot of like flow we've seen in the past and these days as well, whereas like the cheaper wings are like more attractive to own, which kind of creates that like convexity dynamics.
Right. So the implieds are converging to the realized. You're seeing that supply. There's certainly kind of, I mean, just looking at the flows dynamics, definitely feels like there's less demand for the ETH topside and just Vega demand in general for ETH. I mean, Bitcoin's kind of been the big story on the Vega demand side to start the year. But I also think like there is a lot more ETH supply now than there was a few months ago. So let me go to this next slide here. So the ETH vol and flow dynamics, I feel like they've changed quite a bit since the merge. And yes, the implieds are going to converge to the realized for sure. But like I also think that there are flows as well that is driving, you know, these implied and realized vol spread compressions. Like even just this week, right? On Monday, the largest trade that was like half of like all the Ethereum that traded on the entire day in terms of contracts was this first line. So this was 28K ETH, March 1700, May 1800 call calendar, supplying 35K of Vega into the market. 35K Vega, when you think about an equity or FX land, like doesn't seem that big, but like in crypto, in Ethereum, that is a lot of Vega. That is a lot of Vega for the market to consume, especially when like after FTX, there's not, I mean, as Kyle knows, there's not as many market makers as there used to be, right? There's not this ability to be able to absorb this flow as much anymore. And so we saw these trades go up, and I was looking on Twitter, and you know, you have a lot of like crypto vol Twitter personalities and whatever, like, oh yeah, like Shanghai upgrade, like term structure play. It's like the reality is that's in my opinion, it's not correct. This is a systematic roll of an existing call overwrite position. And for avoidance of doubt, we at Paradigm, we don't actually know where this flow is coming from. Like Kyle, this does not print on Paradigm. Which is kind of shocking. That's a different conversation, but it's the largest trade that is going up in the listed market that is not printing on us. And this feels like some sort of overwrite mandate that is perhaps a combination of, you know, some ETH treasury, you know, maybe like a former miner, you know, high net worth, but the execution style is much more sophisticated than just being like, oh, I'm just going to do this like 28K roll. There's a lot of stuff like that's trading on screens around this as well that you just are not looking at in terms of just the general block market. Like we saw similar call calendar Vega selling flows earlier this year in even larger size. I mean, look at that middle one. That's 190K. That's 125K Vega. That was the largest trade of 2022. As the largest Vega trade of 2022, and none of these trades were occurring before the Ethereum merge. This program, we were only really starting to notice these after the Ethereum merge happened, and maybe there's something to be said there around, you know, the whole proof of work to proof of stake, which is why people are looking to get this yield now. But the fact of the matter is, there's now a massive amount of Vega supply in the market in Ethereum that was not there before. And again, on the Vega demand side, there's not very much in Ethereum, and there's a lot less liquidity in Ethereum versus Bitcoin as well. So we don't know the market maker who's putting this up, but whoever it is likely just warehousing this entire thing, right? They have very little avenues to recycle it, and then it just weighs on the entire curve, especially in the midterm buckets, leading to this spread compression. But, you know, clearly there's a huge yield play that's going up in the market, you know, in Ethereum that was just not really there before. Like, when you look at these numbers, Kyle, like, are these numbers in Ethereum where it's like, oh shit, that is a lot of Vega that's trading? Or is it like, I don't know, like, or am I kind of like BS here where it's just like, no, like the market can actually take that down?
That is pretty big trade. Yeah. I think it'll definitely have a trickle down effect on everywhere. For sure. Yeah, that kind of explains why like front falls are suppressed. And yeah, it is a pretty big trade.
Yeah. In terms of, so on, David, I'd like to get your opinions on this, because like we've been going back and forth internally, like who is doing this trade? Like, is this minor overwrites? Like, what are the conversations that you've been having, kind of like on like the vol selling side? Like, who are the type of guys that are looking to do that? Like, are miners still really involved in these sort of like overwrite trades, or is it something else?
Yeah, I mean, to me, of course, it could be a minor, right? Like, I mean, that definitely could make sense. But it could easily be, and I think this is what it is, which is a systematic CeFi option vol, right? Like, so CeFi option vol is like basically, like we talk about DOVs a lot, right? Like we talk about Ribbon, etc. But then there's now a growing universe of people who are managing money for other people. They get like a ETH deposit, and then they sell a covered call, and then after a while they sell another covered call, etc. Right, and it's somewhat actively managed more than the DOVs. So I think that could be a very legitimate form of yield enhancement, which could lead to these kind of flows. We're still, I would say we're still guessing, but the underlying reason is the same, right? Which is yield enhancement.
Yeah, and if you look at the time of the trades, it's definitely happening, unless it's happening through some overnight trader or whatever. It does seem like this is like an Asia-based sort of thing. Like I can't think of any like really large sort of US, sort of like, I guess, private bank in a sense, selling programs over here. It kind of feels like this is like, some yield enhancement program that is a combination between like high net worth and potential miner money. But like at this point, it's pure speculation. So we'll see.
Yeah, it's interesting. I mean, like just on Sohan's point, there are like increasingly a larger number of these sort of systematic guys from the TradFi world coming into the space, and their bread and butter is doing these sort of systematic sort of wholesale strategies. So yeah, it can make a lot of sense that it could just be someone like that. It's interesting how they're executing it. I guess it's always interesting to me when someone's doing that size and they're not doing it through us, particularly when it's listed. Because you got to kind of think about potentially spreads that they'd be paying away on that.
Yeah, that's actually a really good point. That's a really good point. So again, there was this is a little bit of a paradigm shill, if you will, but like these prints have been a point of contention. I mentioned, they don't occur on us. And whenever they do print, we have market makers that are immediately blasting us, asking like, what is this trade? Like, I would have shown a better price. Like, what's going on? Who's doing this? Like, we saw literally this morning, we saw a similar overwrite roll in Bitcoin. So that was in 1,000 contracts, likely from the same counterparty. It's in smaller size. The BTC program seems a bit smaller, but like the first reaction from all our market maker guys are like, oh my God, I would definitely do that trade. Like they would definitely get tighter prices if they quoted on Paradigm. So this morning, we asked one of our top market makers who does not trade this flow, doesn't know where it comes from, where he would have put up, this week's trades. And looking at the chart, trading on Paradigm, so this ETH calendar would have gotten the seller 12.8 more Ethereum, or equivalently roughly $20,000 more dollars. And then for the BTC roll, they would have earned about a third more of a Bitcoin, or roughly $6,500 better. So in terms of spread, both of these are trading around two vols away from mid. And we have guys come in and they'll be like, I would bid this like at least a half a vol tighter. So if you're the overwriter watching this, come trade on us if you want the better prices. But
But it's true. But I mean that leads me to thinking that if this was like a kind of TradFi systematic like Vol guy who's come into crypto, they probably wouldn't be executing it this way. So which makes me think you're probably right, thinking along the lines of it maybe a miner or something like that. Yeah, that's interesting.
All right, cool. I think this is a good segue into some of the CME stuff. And Kyle, I think this is something that you and I like previously discussed, like I think towards the beginning of the year. And it's a conversation that myself, Sohan, and David, I think have had quite a lot, especially, you know, since FTX. And there was this whole view that since FTX and the exchange's insolvency, this is going to drive this very large flight to quality to more regulated exchanges like the CME. And we've been receiving a lot of questions from customers on, hey, has this capitulation actually started to occur in the option space? And additionally, we also see more and more press around it. So there's this article that I screenshotted at the top of the slide. And specifically, so that second bullet point says, the CME benefited from the FTX collapse, with institutional investors looking towards regulated venues. I'm not gonna mention where the article is from, and it is factual that CME Bitcoin volumes in open interest has increased since FTX. That is a fact. However, I would argue that the relative volume growth thus far has not actually been that impressive. And I understand these things take time. It's not just like a flip of a switch and okay, I'm gonna move everything to CME and trade. Like I understand that. But let's look at the data here. So on that chart on the right, in Feb 2022, CME BTC option volumes were 3.5% of Deribit volumes. A year later, in February 2023, CME is 5.1% of Deribit's volumes. So over the course of the year, that's really only 1.5% growth. And it's not like the trend really significantly picked up since FTX. So like I put those arrows there, you know, the pre-FTX, post-FTX, there was this jump higher in January to 7.5%. But when I look at it in the context of like the rest of the trend, it doesn't look like there's been this massive significant increase. And then in February, it's dropped back down to 5%. You know, which is actually lower than where it was in October before FTX. And if you look at the yellow line is Ethereum. And from what I understand, Ethereum is more of a new product for CME. I think they launched it in August, and that's only about 1% above Deribit volume, 1% of Deribit volumes. In the relative growth of CME versus Deribit, it is trending higher. It is. I mean, when you look at the chart, it's going up, but we're still kind of in a reality that a big day on Deribit and Bitcoin options is larger than CME's volume over the entire month. Like Bitcoin options, like on a big day, will do like 1.2 billion, right? And if you look at the chart, there's not one month where CME is doing 1.2 billion. So my whole point is like, and it's might be contentious, it just kind of feels like it's a little bit overblown to me, where it's like that you have this confirmation bias where it's like, oh, it's very logical that you're going to see this flight to quality towards more regulated exchanges. That is a very logical common sense thought considering what happened. But as of now, and I understand it takes time, it's not really happening yet. There's been a lot of questions on our side, not a lot of actions. And this isn't me being like, oh, like, don't trade on CME, like, you come trade on Deribit, like, things are a lot better. Like, don't get me wrong, the CME volumes are trending in the right directions, just not as quickly as a lot of news articles would suggest. And I would love the CME volumes to pick up. Like, that would be a really good sign. That would be a really good sign that institutional players are coming into the market. But at least in the options, I'm just not seeing it yet. But I kind of want to open it up and get everybody's thoughts around this.
Yeah, so I actually I thought about this since like back in like 2018. I thought like like why wouldn't like CME capture all this like like as soon as like they open type of question, but like they're a bit I actually like in the middle, like as we enter like 2013 now, like they're a bit very dominant in terms of market share. So yeah, like my takeaway, like very similar to you in that like it takes time. I think like yeah, US institutional volume will eventually go to CME, but on the other note, for every product I've seen in CME, there's always like it could be like could have some like correlation to like how like CME incentivize like market makers or to like grow the markets and like how they like maneuver on this as well. Usually there's like for like I can't think of like yeah for pretty much like all products except one, there's always been like jump in like future growth first preceding options growth, and
Right.
that is something we're seeing. I believe like last time I checked, like CME volume and open interest on like futures relative to like Binance or like entire like perpetual market has been like pretty significantly increasing. So I think it's fine, but like that I think that's like a sign that like options will like follow at some point. But
Right.
like I think they also probably want to like grow like future volume first, like for options to be sustainable. Because like yeah, without like yeah, if there's like no delta liquidity, like options markets are like hard to build up on. Like so I think like it's taking time.
Right.
I think, I mean,
that we go for it, David.
Yeah, I mean, I think just a couple of thoughts from me. First, it's expensive, right? Cost of margin is makes it more expensive. I also think it speaks a little bit to the still fragmented sort of market and regulatory environment in crypto, and particularly out of the US, that just is really feels like it's kind of falling behind the curve on the regulatory side. The problem with that is if you're going to open a crypto fund and you're going to want to trade some options, you're going to want to trade some spots, some perps and futures and whatever you're trading, you want access to as many kind of sources of liquidity as you can get. Right now, it still feels like the route that people will go down is setting up an offshore entity so that they can then have access to the offshore exchanges and access deeper liquidity. And yeah, like you got to pay up for it if you want to go on the CME. And then also, I just feel, from a portfolio point of view, whether you're kind of just a little bit limited. So therefore, is the route that people go down, and certainly conversations I've had when I'm seeing funds actually set up and they're trying to work out the best way to do things. And often they lean to, right, we need to set up an offshore entity and be trading through Deribit and the other exchanges that we can't otherwise access. So I still think that kind of fragmentation with the regulatory environments is causing issues as well.
Yeah, I mean, I can give some anecdotes. So it was actually exactly the margin point. So the most common pushback is, I would love to, but it's just too expensive. And then if you have no mandate to trade on one of the offshore exchanges and you have to trade on CME, then actually the response is, I would rather go OTC and trade against somebody direct, with a CSA and ISDA, right? Which is a shocking thing, right? Because you obviously get netting and everything in CME, but it just tells you that that there are certain things that CME could do better to kind of pull that flow away, right? Because if you had the choice between CME, OTC, or Deribit, like if they're equal to you, then you would of course go Deribit, right? But then if you're mandated, then it's shocking that people would choose a bilateral avenue rather than the exchange just because of margins.
Right, especially in an environment where nobody trusts each other, and I imagine the OTC margins get pretty nuts too.
That's right.
But Cool. No, that was a good discussion on the CME. I think we can leave it there. David, you want to get into a little bit of the macro?
Yeah, I mean, it's an interesting week, I guess, to be talking macro, especially ahead of the NFP on Friday and CPI on the 14th.
Come on, I want predictions. I want you to put your foot in your mouth. What do you got?
Yeah, well, I mean, look, I've been pretty bullish risk, as we know, coming into this year. We put out on the newsletter earlier in the week that rates is the missing piece of the puzzle. One of the things that I think is really interesting to me is the lower sensitivity of risk to rates. So we had Powell obviously speaking over the last 2 days and sort of talking about the fact that he's prepared to go a quicker pace of hikes. We've seen the market price in basically 50 points for March now is pretty much is I think about 70% priced in. And also we've priced a higher terminal rate again in a really short space of time. We're now pricing like 5 3/4 of a terminal rate from 5.5 just last week. So we're having some really big moves in the front end of the rates market, but we're not actually seeing risk materially get hit, and everyone's kind of waiting for risk to get hit, and it's not happening. I think one of the reasons for that is people were saying after Powell yesterday that the market's starting to listen to the higher for longer scenario. But actually, I think the market's listening to the higher for longer, higher scenario, but still not buying into the higher for longer. And one of the things that I was looking at is if you look at the interest rate futures, so if you look at the September contract against the March contract, so whilst we're pricing at a higher terminal rate, we've actually, over the course of this week, started to price in more cuts into March of next year. So we're pricing about 50 bips of cuts. If I share my screen, I'll show you what I mean. Yeah, so this chart here, so you're looking at the September 23 contracts versus the March 24 contracts. And what you'll see is actually since like the end of Jan, when we started to get this stronger data throughout February, so markets have certainly priced in a higher and sort of steeper rate path. But since if we look at the last couple of days and since last week, we've actually started to see that reverse. Now, again, you've got a higher peak coming in September where we're now pricing 5 3/4 rates, but we're actually then starting to price sort of cuts into March next year a little bit more aggressively. So I think what's interesting from a risk perspective is the more that Powell hooks things up, we're pricing in this higher peak rate, but then subsequently we're pricing in quicker cuts. So again, this idea that the Fed are going to have to just front load it, but actually the bigger concerns are around growth, and that eventually we're going to see this start to hit and come through. So yeah, so I think that's quite interesting, just how kind of insensitive risk is to these big moves in rates. So it kind of makes me feel that there's still an asymmetry in risk, in that as soon as those rates start to turn lower, then we can start to see actually sort of risks start to fly, and obviously risk and crypto are going to go hand in hand with that. So on the one hand, you're kind of looking at rates thinking, there's reason to be nervous. On the other hand, we're really not reacting or responding to these big moves in the front end of rates. And I think that's because the more we're pricing in at the front, then we're also sort of pricing in the cuts at the back end. And hence you've actually started to see sort of 10-year come a bit lower this week, 30-year come a bit lower. So duration's actually starting to rally on these steeper hike sort of pricing. And then obviously sort of crypto is the longest duration asset. So I'm kind of the view that actually, again, it feels like the downside feels limited for duration, feels limited for NASDAQ, feels limited for crypto. And I think as soon as we start to see that those rates reverse at the front end, if we get some weaker data on Friday with non-farm, weaker CPI, then I actually still feel that the bias is that we're going to push to the top side, even though it just sentiment feels awful out there and everyone's waiting for things to collapse. The other thing within that is, again, just looking at other risk metrics. VIX is sat below 20. We've had this huge rates move, and yet the VIX is still sat below 20, looks pretty comfortable. Liquidity is still high. And actually, if you look at the Bloomberg Financial Conditions Index, we're actually sort of lower year on year than where we were this time last year, despite this massive hike cycle. So financial conditions are easing. So actually, like risk actually looks quite supportive if you took away this kind of rates move that is causing, I guess, concern. And then the other things that are still interesting to me in terms of where a lot of liquidity is coming from, it's been coming from the East. We've seen PBOC, Bank of Japan, I think since about October of last year, they've injected about $1 trillion into markets. So there's been a huge offset to what the Fed have been doing and what the ECB have been doing. I think China disappointed a little bit in the week by saying that they're only going to sort of target 5% growth. So that's reduced the optimism that they're going to come out with some sort of power stimulus. And then we've also got the new Bank of Japan governor, Ueda, sort of going in. I think it's correct. Kuroda's last outing on Friday. Now, Ueda's actually been kind of making some dovish noises. So I think that's interesting to watch. If you still see China and Japan keeping the foot on the liquidity pedal, then again, I think we're setting up for still a decent rally and risk. So interesting into non-farm and CPI. Powell actually today, I think, rode back on his comments a little bit, and essentially it sounds like whether he goes 50 or 25 is going to be dependent on whether we get a strong non-farm and CPI. But it feels, given that reaction to rates at the front end, it feels like there's an asymmetry for me lining up for risk that basically if we do get strong prints, well, the 50 is kind of priced. If we get weaker prints and we go back to pricing 25, then all of a sudden, I think you're going to see stocks and risks sort of take off, and then everyone unwinding the flows we've seen this week, they've been putting on the downside and go back to scrambling for the top side in crypto.
David, when's the non-farms on Friday, right?
Non-farm Friday, CPI is the 14th, which is what, Tuesday?
Yeah, it's interesting where, like, I'm surprised. I'm just looking at where the at the money vols are for March 10th. It's 41. Right? Like, doesn't seem like anybody cares. Like, it's surprising. Like, obviously it's really important, but like, I feel like in crypto, you've tended to see pretty steep term structure inversion around like CPIs and things like that. I'm pretty surprised. Maybe you have to give it a couple days or whatever, and you get a little bit closer to it. But that's pretty shocking to me that the lowest point basically on the curve is Friday, given the fact that we have NFPs. I
mean,
might just not. Yeah, go for it.
Yeah, I mean, I was going to say it's possibly the timing of when the expiries are, and
I think you're right. Yeah. Damn it.
It's just before, in fact. So it's just a few hours before. That's kind of why it never shows in Deribit, right? Like,
yeah. We'll cut that.
Yeah. But I think what is interesting, Joe, is because we're still in this positive spot vol correlation world. So if you think if your sentiment's pretty bearish, then you're going to kind of want to price for lower vols, right? Because you think, well, spot's going to come off and vol's going to come off with it. If you're starting to get a little bit balled up, then you think, you want to start positioning for a higher vol regime with higher spot. So I actually think the lack of reaction in vol is kind of maybe alluding to some sort of short-term bearish sentiment, which again makes me think there's an asymmetry into this data that if it's soft and we can all chill out a little bit on the Fed, rates come lower, then I kind of think we're going to see a scramble for people to buy back that vol and again put back these convexity trades and start sort of grabbing some of the top side.
Oh yeah, I mean, Kyle, we see it all the time. As soon as you kind of have like a little bit of a sharp candle higher, you see everybody start to come in. 2,500 up, like Ethereum 1 month calls and things like that, just trying to like kind of perpetuate those moves. As we've discussed, it's such a reflexive space in that regard.
Yeah, and it's. Yeah,
when you say spot vol correlation, like positive, you mean like vol up, future up, vol up type of
Yeah. So that's been what we're seeing, right? And it's strange to get your head around that, to think that if Bitcoin sells off, on Friday, to think that actually Vol's just going to come lower. But that's kind of the regime we've been in, right? Whereas if Bitcoin, we get a really soft print, rates come lower, and then all of a sudden Bitcoin starts sort of pushing back through 23K again, then Vol's going to go bid, right?
The problem is, though, like, I understand that when you have Bitcoin at like 24, 25, and the vols are kind of already pretty elevated, like in the 60s. Now we're talking like, okay, now we're talking the front end, like in the mid 40s. I think down here, especially at the bottom of the range, I think that dynamic, like I just can't see a world where like we have a hawkish print and then BTC is off like 3% from here and vols are lower. I mean, maybe they can be like, at best, like unchanged, but like the absolute level of implieds now are like pretty damn low, where like maybe that correlation is starting to break down a little bit.
Yeah, I think I think dynamics have shifted a lot versus when we're like around 25K. Like, yeah, definitely like we like see more like put bidding. I think convexity should be higher on lower vol as well. Convexity will flatten out on as like calendars get offered, so like fronts get bid. On down ticks, like most likely backs will like somewhat, like it's hard to like predict what like flow will be on in the back months Vega, and on down ticks might get bid or offered, but like fronts I think will like definitely like adheres to the downside at the moment in the market. I think it's very interesting, like we have like this like very like sophisticated conversation in macro level, like back in like 3 years ago. It definitely didn't have as much like a macro touch in crypto options. Everyone's like talking about markets, macro, or like pricing like events, and it's pretty interesting.
That's what happens when a bunch of TradFi boomers like David come into the space.
Who are we kidding? We're all boomers.
Boom, zinger.
We're all TradFi boomers.
But it's true. But you're seeing it with the sort of client base, right? You've got so many of the sort of TradFi guys. I mean, Carl, former FX gold guy, there's so much TradFi coming in and kind of realize the importance of that. And then that then becomes, if that's where the flow's at, that becomes a driver. And particularly this year, I mean, we've spoken about this before. It feels like a lot of the move has been driven by institutional flow. It doesn't really feel like the retail markets like really been aping into stuff and sort of driving things. And in fact, I kind of feel like if we're really going to sort of push on, that might be where we need to actually to start breaking higher levels and ramping higher. You're going to really need retail to come in and get involved, but we're not seeing that at the moment. So yes, the institutions, the boomers maybe are dominating things at the moment.
And I think it's kind of like self-fulfilling prophecy in a way. Yeah, it doesn't have to be that way, but like a lot of people think that way, so it becomes that way. And yeah, there are a lot of players like doing like obviously like analyzing correlation between like Bitcoin and equities. Like it like there were regimes like where like there's no correlation. Like there has been like correlation like last like probably like good like period of time. Like it's also like breaking down a little bit, but like there's some like I think there's like interesting dynamics there. I do think it could be like a little like over pushed in a way. Like I think there will be regimes like it doesn't have to be correlated. Like I think there are players like who like basically like do like correlation plays, like including Bitcoin versus like equities, which is probably like makes sense. Like trade like goes with like in line with like how ETH trades like Nasdaq stocks. I think that narrative makes sense, which is why like ETH should have like natural put skew, like probability options traders, like we all think like very like probabilistic manner, and like there's like it's very unlikely at this point, but there's like non-zero probability ETH can like go down to like 0, like it's like non-zero. So but yeah, like Bitcoin, I feel like it, like at this point, like I think like it kind of explains like the whole dynamics, but like Bitcoin, yeah, I think running like a little like more positive call skew than ETH makes sense. On upticks, like yeah, I don't think it's like unreasonable, like skews can get bit to the calls. Like I've seen call skew in gold multiple times. Very similar dynamics.
Yeah. So something else I think is interesting, and I guess this kind of ties like some of the macro to the flow sort of dynamics that we've discussed, is I always say that narratives ultimately drive markets. And I think if we look at how we came into this year, the narrative throughout Jan was this peak inflation, peak rates narrative. The data was kind of supporting that. Rates were coming lower. Risk was rallying on the back of that. And you had this really nice narrative that we approaching the pause and the Fed pause and the rate hike cycle. Now that narrative's, say, if not completely disappeared, but it's a lot more complex than it was given the strong data. Now there's no clear narrative. And I think we're all struggling for that. Clear narrative to actually sort of really commit risk. So in the absence of that narrative and commitment to risk on the back of that, then you're left with what I'd call like the mechanical flows. And those mechanical flows are these call overwrites and these structured sort of vol selling. So therefore, in the absence of a narrative to start sort of bidding up vol and putting on top side, you end up with these kind of mechanical structured flow that's not trading the narrative, not trading the macro in any way. And then we just kind of drift lower in vol. And I kind of think that's what we're seeing. And this market needs, one way or the other, needs a new narrative to really start sparking vol and hopefully our volumes in tandem throughout March.
Yeah, actually, I have a question for Carl. Actually, I mean, it's a bit of a move on topic, but like, you know, like one of the big issues I think all of our prop shops and you know, like market makers face is that there is too much, like after FTX, there's too much focus on having single CeFi risk, right? So you know, everyone wants to diversify, everyone wants to like move out of you know, of the main exchanges, despite, you know, preferential like pricing or margin, etc. So we saw that with CME a little bit, but you know, as we know, it's not like grown that much. But like, what about Deribit? I mean, like Deribit has been dominant for almost, like, I guess 3 years now, and that, you know, there are many up and comers in the crypto options exchange space, but they haven't really managed to get any of the volume. What do you think about that space? And you know, are you active in any of the other exchanges?
For specific for options, right?
Yeah, just for options.
Yeah, we trade on other exchanges as well, other venues as well. But yeah, I guess we, as a more trading perspective, we have to follow the volume to make money. Like, yeah, it's fair assessment. Yeah, I think, yeah, the exchange like level risk, that's something we're aware of. But like I think it's just a risk we have to take being in this space, and like as long as the volume's there, like as a market maker, we have to like kind of chase the volume.
I see. And in terms of like let's say you have obviously CeFi, right? But what about the DeFi space? I mean, are you active in like Ribbon or all of these you know, like you know, DOB type you know, spaces?
We are, but not super active. It's for like, it's more just operational like annoyance, I would say, and like, yeah, risk as well. But like I think like it's more like it's not that like big enough at DeFi space. Like we are like actively looking at DeFi, but like the volume, like notional volume there versus like CeFi is like so small. I think what's interesting to us is like more like cool developments in the space. There are like cool products coming out, I would say. Yeah, I mean, like I think perpetual is like one of the greatest inventions that crypto created. It's a great product. It makes a lot of sense. No need to like roll all that. And yeah, there are like interesting projects like the Squeeze, Pretty type of products that kind of does that on like fixed feature level. Like, so like I think like all these like trials like on like product level using crypto is like super interesting. But yeah, there's like not much volume, probably like little here and there, but like it's like for our size, it's hard to justify like spending too much time like trying to make those kind of trades work at this point.
Yeah, I mean,
go on, sorry. Go ahead.
Yeah, I mean, actually, the one point you mentioned, which is, I guess you were referring to the upcoming DVOL future, right? I think that to me looks extremely exciting, right? Because it's sort of now referencing the VIX on every single, call. Like we just say, oh, the VIX is here. We can actually have our own, crypto, market where we can trade it so aggressively, right? Like as in market makers can now use that as a hedge, as well as hedge with vanillas on the future with vanillas. Like I expect that to be a fairly big market going forward.
I hope so.
Yeah, what's your view on that? I've heard mixed opinions. I've heard mixed opinions that like this is a great thing, and I've also heard opinions that the market's not ready for it.
I think it'll take time to develop. It's not gonna get traction too soon. Given also like there been like even like future volume is a little like meager. I don't see like how like DVOL futures will get traction soon. I think I'm more like interested in product design perspective. Like love to see DVOL on like perpetuals. I think that's not like that's coming out on day one.
Yeah, is that more so around like the expiry management sort of deal? Because I mean, in equities, fixed expiry is a big deal, and in crypto, I mean, I never really touched fixed too much, but my understanding was to hedge some of this stuff, you would trade 2 strips of options in a calendar. So let's say like I buy like a DVOL future, I would trade this calendar strip as a hedge, and when expiry comes, my front leg is not going to expire at the same time as the DVOL expiry, right? Because we're talking about a Wednesday expiry versus a Friday expiry. And when I see this reality, I'm like, okay, we're not at a point where liquidity in dailies is not that high yet. So everybody's gonna have the same position on. Let's say this market was big. Everybody has the same position on, and you're gonna see this scramble for options where liquidity is gonna be poor. Like on S&P, you actually have a fairly liquid Wednesday expiry where you can actually, trade, you can easily hedge it. But like in BTC, when, are you gonna have the liquidity into dailies when all the market makers are gonna, potentially have the same position? But I can't be sure of that. Like that's just kind of like my initial intuition speaking.
I think the exciting thing from my point of view, again, it's just another step in the evolution and maturity of this market. And if you look at the derivative space, it's super important in terms of institutions being able to come and play in this space, in terms of how they're going to hedge risk. And it's just another product that's going to allow that. And it just keeps amazing me how quickly this market is evolving, this asset class evolves. And despite, all the shit that's gone on over the last year, be it with FTX and Celsius and all the other things, like, yet here we are still seeing new product launches, still seeing the space evolve in quite a positive way. So yeah, I think it's super exciting. Yeah, it'll take time to build, I'm sure, and to provide liquidity. But again, everything's going in the right direction. And we're seeing, again, I've said it before, we're seeing the evolution of the sort of TradFi world that went on over decades in such a short sort of sped up time in crypto. It's pretty phenomenal to watch and be a part of as well.
Wow, I think that's a great way to cap it off, David. That was beautiful.
Thank you.
I think we can. We're approaching.
He's the biggest cheerleader we have.
Pro crypto, pro risk, love it. Kyle, thanks for joining, man. Always happy to have you.